Okay, good morning. Today we are going to start on Chapter 10. We do have a question out in Learning Catalytics right now relating to last week. So get logged into Learning Catalytics. This question will be open for a couple minutes. So, while I talk and start the material, this question is going to be. So if you're just joining us, you want to get logged in. Which of the following accounts below is usually not a liability? And I do want to point out right now, if you're looking at Learning Catalytics, it should say question 18 on it. This question numbers have no significance to you at all. I started putting question numbers on them so that Haley and I can make sure we are referring to the same question. So the question numbers are not meant to be what order we're doing them in, which question. It's just that so Haley and I don't put up different questions at the same time again. So which of the accounts below is usually not a liability? Again, the question is going to stay open for a minute or two, but we're going to go over the answer right now. Investment in bonds is an asset. So that's not a liability. Again, this first question is going to stay open in Learning Catalytics for a little while. And so to give people that are just joining us late a minute to get logged in. Okay, so what's due this week? Saturday, November 15th, this Saturday, we have Chapter 10 homework 2. If you're in Section 3, which is the vast majority, not the vast majority of you, you will also have a quiz due. Okay, so we're going to do Chapter 10. So we're going to start today. Chapter 10, Haley and I were talking this morning before we started class. Chapter 10 is a really neat subject. This is one of the subjects that you hear the most about in news media. You hear a lot of companies having news about stockholders' equity. And I'll try to tell you some things as we go about current things that are happening. So stockholders' equity. What we've done in this class is we started with the assets. We went through all the assets. And then we recently completed liability, and now we're down in equity. So this week we do equity, and then in future weeks we're going to cover the different financial statements, and we're going to cover, we end up this semester in 4 weeks, we end up financial statement analysis. So now we're putting all the pieces together, but this is the last piece of the balance sheet here. Okay, so first of all, stockholders' equity. You can only have stockholders' equity if you are a corporation. You have to be a corporation to have stockholders' equity. So features of a corporation, well, the advantages of a corporation. You can raise more capital than a sole proprietorship or a partnership can do. Continuous life, meaning you don't end when someone wants to get out of the corporation. There's ease of transferring ownership. And the stockholders are only liable for the amount they have invested in the organization. They don't have personal liability. A corporation issues stock, so to become a stockholder, you simply give money, get the stock, and it's easy to transfer ownership. You can sell it to someone else. So we can raise more capital by being a stock corporation, and it's easy to transfer ownership. It doesn't end if someone dies or goes elsewhere. And then stockholders, as stockholders, we aren't personally liable for the business, only an amount we have invested. Now there's some definite disadvantages to a corporation. Ownership, the stockholders are a different group of people than the management, and we might have different objectives. Stockholders typically want to get a good return. They want to see the stock price go up. Managers usually want to increase their own bonus. So we've got perhaps different goals of those two groups. We have double taxation. And we have government regulation. If you're publicly held, absolutely you've got all kinds of government regulations about governing what you can do and what you can't do. Double taxation, I'm going to circle back to that. Double tax means that as a corporation pays its own income taxes. So a corporation files its tax return and pays tax. If you're a sole proprietor or if you're in a partnership, the partnership or the sole proprietorship do not pay taxes. You as an individual do. Sole proprietor, that net income flows through to you. You put it on your personal return. You're done. So you pay tax on all of it. A partnership, you get your share of the net income gets put on your own tax return. So the partnership or the sole proprietor, the entities do not pay tax, only the individuals. Now when you get to a corporation, the corporation pays tax. So the corporation earns money. The corporation has its own legal identity, so it files its tax return and it pays tax. Okay, but then the owners of the company, all the stockholders, get dividends. Okay, so the corporation pays dividends to all the shareholders, and the shareholders then have income and have to pay tax on those dividends. Dividends are not tax deductible by the corporation, but the shareholders have to pay tax on their distribution in effect of the income. So we say it's double tax, it's subject to double taxation. But there's a lot of reasons why companies do organize as corporations. A lot of times limited liability, ease of ownership, the fact we can raise more capital, but this double taxation does take place. Okay, Exhibit 10.2, we don't want to memorize this, but the point of 10.2 is to tell you at the very top of a corporation are the shareholders. The shareholders buy stock, and then they have votes, and they elect the board of directors. The board of directors are who runs the strategic or comes up with the strategic vision of the company, and then they select the chairperson of the board, and then chairperson works with operating personnel. So shareholders are at the top of the organization. Again, not memorizing this per se, but it's Exhibit 10-2. Okay, now as shareholders, so we're talking about regular common stock, there's 4 sets of rights. Okay, you have voting rights, meaning you have the right to vote on matters that come before the stockholders. So a lot of times we have votes on whether to accept a purchase offer. So another company may offer to buy us, and they offer a purchase price, so the stockholders will vote on that. Another time stockholders vote is certain stockholders will come to the board and say, I want to make a proposal that the company invest in this technology. So stockholders can make proposals and other stockholders vote. The stockholders also ratify the auditors that are used. So the stockholders vote on what auditing companies use. So we have the right to vote. Then as a common shareholder, we also have the right to receive a proportionate share of any dividend. So all the shareholders, if a dividend is declared, all the shareholders get that dividend, all the common shareholders. Liquidation. We have the right to receive a proportionate share, meaning your relative proportion of any assets after the corporation would liquidate. So if the company goes out of business, any assets are left over after everything's paid off get divvied up between all the shareholders relative to their proportionate share of ownership. And then the last right is preemption, meaning you get to keep your proportionate share of the pie. Okay, so you own 10%, you get to keep 10%. We have lots of vocabulary today, lots of terminology that goes on with stock. So shareholders' rights, definitely would know those. Now, when we talk about this vast category of stockholders' equity, so this section of the balance sheet, there's basically 2 types of stockholders' equity. The first type is paid-in capital, and the second type is retained earnings. So in stockholders' equity, we have 2 main sections, paid-in capital and retained earnings. Paid-in capital is also called contributed capital, and it's the amount of equity that shareholders have contributed. It's basically we've issued stock and this is what we've gotten in return for it. So that's paid-in capital, everything that's been received from shareholders. So you invest in stock in a company, everything you invest goes into paid-in capital in this general category. There's lots of accounts within this paid-in capital category, but paid-in capital holds all amounts that are invested by shareholders. Okay, now, so paid-in capital represents the amounts that investors have paid for stock, basically. Then the other category is retained earnings. Retained earnings is a running total of all the corporation's earnings to date, less any dividends declared. So the retained earnings goes up by earnings. So we make income, that makes retained earnings goes up. If we have a loss, it makes it go down, and it's reduced by the dividends we declare. If you're just joining us, the first question in Learning Catalytics is still out in Learning Catalytics. So you want to get that answered. We're going to be closing it in a minute or two. Okay, now, within stock, when we talk about stock, there's two types of stock. Very specific words. There's common stock and there's preferred stock. And common stock is a specific term. I'm not meaning like general stock. I'm meaning common stock. So we have common stock and we have preferred stock. Common stock, every single corporation has common stock. Every company has common stock. Preferred stock, not very many. So preferred stock is pretty rare, but we need to know it exists. But every corporation has common stock. We can assume we're dealing with common stock unless indicated otherwise. Common stock is this basic form of stock. It has those 4 rights, and shareholders with common stock benefit the most if the company does well. Okay, they're going to get stock price appreciation. They might get dividends. Dividends might increase over time. So common stock is where stockholders stand to make the most money. They also take the most risk because they don't get paid dividends until everyone else is paid. They don't get, if the company goes out of business, they're last in line for liquidation assets. So we have common stock. Then we have preferred stock. Preferred stock gets dividends before common stock. So they get their dividends. If any dividends are paid at all, it's going to be preferred first. They get assets first in liquidation. Now, the downside or upside to preferred stock is they get a fixed dividend. Preferred stock will say we might have 5% preferred stock. 5% preferred stock means you're always going to get 5% of that preferred stock par value. Every time, no matter if the company does good or bad, if a dividend is declared, you get that same amount of dividend. So the company can go do really, really, really great, and you're still going to get the exact same amount. Few corporations issue preferred stock, but it does exist, so you need to be aware that it lurks out there, that it is possible for a company to have preferred stock. Most of what we do in here will be common. We'll see preferred stock a little bit, but most of it's going to be common stock. Okay, more terminology. We have par value and no par. Par value is an arbitrary amount assigned to a share of stock. So par value is legally set. And it's usually pretty low. It's usually like $1 or 5 cents or 1 penny. Apple stock has a par value of 0.001. 0.00001 cent. So 4 zeros and then the 1 cent. And it's an arbitrary amount. It's usually set low to avoid legal issues. What we're talking about here, it's legally in some states you cannot sell a share of stock for less than its par value. So companies will simply say, okay, we're going to set our par value low. Par value is set when the company organizes. When it originally incorporates, in the Articles of Incorporation, it talks about the par value. So typically they set it pretty low. It is just a legal distinction. There's nothing magic about par value, but it is usually low. Sometimes we can have no par stock, so we'll see that. So in some states, you don't have to have a par value, so companies will have no par stock. You can also have something known as a stated value. A stated value works like a par value. They're not the same. By and large, I don't know if most, but many companies have par values. So usually you'll see a par value. But we can have no par stock, and we can also have stock with a stated value, which kind of functions like a par value. So those are just terminology. Okay, now what we're going to do, now that we talked about the basic vocabulary, is we're going to go through a handful of journal entries that talk about what happens when we issue stock. And so I would know all the journal entries we do today are good journal entries for your reference purposes. So we're just going to start in on those. And again, we're going to be closing Learning Catalytics after I get through right in the middle of these journal entries. So if you have not submitted your answer, you're getting down to your last minute or two to be able to. Okay, so we're going to talk about issuing common stock. This first one, Home Depot needs to raise $100 million through issuance of stock. Companies basically raise cash 2 or 3 ways. First of all is to make money, have earnings and have customers paying you, and you've got this influx of cash. So that's one way. The other way is to issue debt, and another way is to issue stock. So here we're talking about issuing stock. So Home Depot wants $100 million, so they issue stock. Suppose the common stock carried a par value equal to its issuance price of $10 a share. The entry for issuance of 10 million shares of stock at par would be. Okay, so this is the most simple case we can have. Par value is $10, the market price is $10, so we issue stock. We're going to debit cash for the amount of cash we're getting, credit common stock. This is what we've done up to this point. All through the semester when we've issued stock for cash, we have assumed that par value is equal to the market value. It's usually not realistic, but this is where we started before today. So we were issuing stock, we have cash coming in, we credit common stock, okay? And this is when par value equals market value. So this is going to be extremely rare. It's not going to happen. Typically, par value is going to be really low, and we're going to recognize it. So what we're going to do next is our next journal entry is a more realistic situation where our par value is low, market value is much higher. How do we record it then? So because par value is recorded a little bit differently from everything in excess of par. So next situation, okay, Home Depot needs to raise $100 million through issuance of stock. Suppose Home Depot's common stock had a par value of 5 cents. The entry for issuance of 10 million shares of stock at $10 per share would be, okay, so what we're going to do here is we are going to debit cash. So the cash hasn't changed. The market value per share of stock is $10. We have 10 million shares times $10, so we're still getting the $100 million cash. Now, common stock here, common stock is always recorded at par. So you want to make a note. You're always going to record common stock at par. And this is what we're doing down here. We have 10 million shares at 5 cent par value, and that's what is being recorded for common stock. So common stock only gets in it par value. If you ever want to know how many shares of stock are in there, you can take the total balance in common stock, divide by the par value, that'll get you the number of shares. So we're cash for the whole thing, common stock's par value, then the difference goes to an account called paid-in capital or paid-in capital in excess of par. So we are just going to have paid-in capital is everything above that par value. And also we know that our debits have to equal our credits. If we have if we're getting 100 million cash and our par value totals 500,000, the difference is that paid-in capital. The second account, the second credit, paid-in capital, you might also see it as paid-in capital in excess of par. You might see it paid-in capital in excess of par dash common. It'll be something, but it's something paid-in capital it's going to be. We just simply legally cannot put anything besides par value in the common stock account. Okay, so this was a good example of common stock issued at a price above par. And that's going to be the case in most instances that we record common stock at a price above par. So once we do this, if we would look at the balance sheet and look at the stockholders' equity section, we're going to see stockholders' equity. And again, you don't need to write all this down. I just want to show you that common stock and stockholders' equities first. It gives us a bunch of information. Coming up here soon, we're going to talk about what these terms mean. We're going to talk about what authorized means, what issued means, and what outstanding means. But when we look at a balance sheet and we have a stockholders' equity section, we will see the par value, we will see how many shares have been authorized, how many have been issued, and how many are outstanding. Just as a quick overview, authorized is set when a company incorporates. They come up with a number that says, this is the maximum number of shares we will ever issue. So it's a huge number typically. And you can't change that without legal action. So in this case, Home Depot has authorized shares of 10 billion shares. That simply says this is how many we're allowed by charter to issue. They've actually only issued 10 billion. And we're going to come up and we'll talk about the difference between issued and outstanding. So we have common stock, we have paid-in capital. So that's where we have that paid-in capital section part of stockholders' equity. And then the other part is retained earnings. Okay, retained earnings is just simply the accumulation of all our earnings. Haley, I'm taking that one. Or whatever, if you want to do it too. Retained earnings is given to us in this case. We're not calculating it, but retained earnings is the running total of all our earnings to date less any dividends declared. Okay, so we're not calculating retained earnings here. That's just given to us. Okay, if we issue no par stock, we simply just have cash and common stock. There's no paid-in capital account. It's simply no par stock, everything goes into common stock. Okay, so no par, everything goes into common stock. There is no paid-in capital account. We have one more journal entry. And in this scenario, what happens when we issue stock for something other than cash? This is quite common. When you start a business, you'll decide to incorporate with a group of other people, and some people will say, I'm not going to donate cash to give cash to the corporation. I would like to give a building. I have this building we can use as a storefront. That'll be my contribution. So what happens when we do this is when we issue stock in exchange for something other than cash, we record whatever that is at market value. So let's do an example here. Okay, in our example, a corporation issued 15,000 shares of its $1 par common stock for equipment with a market value of $4,000 and a building with a market value of $120,000. So what's happening here is we record the building and the equipment at market value. So they told us the equipment is worth $4,000, the building is worth $120,000. So those are market values. Whatever you're debiting here, this could be an expense. This could be some kind of services they're providing in exchange. We would still debit it. So it could be something expense or an asset, but those are equipment and building are debited for market value. That's important. When you exchange your stock for something, you record that something at its market value. Then we're going to credit common stock. Common stock, as before, only gets par value in it. That is a big rule. Unless you have no par stock, common stock only gets the par value. So we have 15,000 shares, $1 each. And then paid-in capital, that paid-in capital balances the journal entry. So we would take the equipment plus the building, subtract the common stock, and we get 109,000. So the equipment plus the building, 124,000 minus the 15,000 gives us the 109,000 we need to balance the journal entry. So when we issue stock in exchange for something other than cash, we record the something at its market value. We're going to be doing a couple questions now. Again, just as a reminder, when you're looking at them and learning Catalytics, and on the screen here they have question numbers on them. The question numbers don't mean anything to you. They're just our numbers so that Haley and I make sure we're delivering the same questions. So question 1. So again, question 1 doesn't mean, it's actually the second question we've done today. When 100 shares of $1 par value common stock are issued at $25 per share, paid-in capital in excess of par will what? And we did a journal for one of these like this. So what's going to happen to paid-in capital in excess of par for this one? So what's happening in this question is we have 100 shares of $1 par value common stock issued at $25 a share. So we know that $1 is going to go into common stock. The difference is going to go into paid-in capital. So we'll take about another 10 seconds to get an answer in. Okay. What happens here is we're going to increase paid-in capital in excess of par by $2,400. That's because we're paid $25 a share. We have $1 par value, so the difference is $24. $24 a share times 100 shares gets us to the $2,400. Okay, next question then. If stock is issued for an asset other than cash, the asset should be recorded on the books of the corporation at what? Yes, that's right, Alexis. Okay, if stock is issued for an asset other than cash, the asset should be recorded on the books of the corporation at what? 10 more seconds and we're going to close this one. Okay, it's fair market value. And then we have one more. Wolverine Corporation issued 5,000 shares of its $5 par value common stock on payment for attorney services of $40,000. So the attorney services valued at $40,000. Wolverine stock has been actively trading at $20 a share. When we record this transaction, what's happening? So take about a minute and then we'll go over this one. Okay, Wolverine Corporation issued 5,000 shares of its $5 par value common stock in payment for attorney services of $40,000. Wolverine stock's been actively trading at $20 a share. This transaction would include a what? This one, think about the rule. We're going to close it in 10 seconds. Okay, and the answer is going to be debit to legal services for $40,000. The legal services market value is $40,000, so we cannot use A. We're not going to record them at $100,000. We would not credit common stock for $100,000 because common stock only gets par value. The D, the fourth answer, is not correct either because common stock, again, only gets par value. The only answer this can be is B, legal expense. We value legal expenses at their market value. So when it says legal services for $40,000, that's its market value. Okay, now on to preferred stock. And we're just going to have one. We're not going to dwell on preferred stock. Preferred stock has the same pattern of accounting as for common stock. We might have separate accounts for paid-in capital. We might have one paid-in capital preferred, paid-in capital common. And it can be issued with a conversion feature. So it could be convertible. Okay, a conversion feature. What a conversion feature is, it means that at some point in the future, that preferred stockholder can trade the preferred stock in for common. So why might they want to do that? You've heard of Crocs, right? Everybody's heard of Crocs. The company Crocs is not doing well financially. So they needed some money to be operating with. So an investor group came in and said, we'll give you $200 million for preferred stock. So Crocs has issued $200 million of preferred stock to the investor group. The investor group has a convertibility feature on it. And what that allows them to do, so the investor group, if Crocs goes out of business sometime soon, then the investor group since they have preferred stock, gets liquidation assets before all the common shareholders. Okay, so that's good. But let's say Crocs takes this $200 million that the investor group gave them and invest it and come up with new shoes, and they're popular again, and they're doing great. So then the investor group can use that convertible feature on the preferred stock and trade it in for common stock. And why would they want to do that? Well, common stock is going to pay dividends, potentially higher. The market price can go higher. You can make a lot more money on common stock than you can preferred. But for right now, that investor group wants the preferred stock because it is risky investing in Crocs, because we don't know, will they be able to make it through this rocky patch or not. Okay, so that's it. The preferred stock. Now on to some dates, dates and definitions. We have, when we're talking about stock, we can refer to authorized, issued, and outstanding. Authorized, as I said before, is the maximum number of shares a company can issue under its charter. Okay, so a company can never issue more than this, unless they do a legal action to change the charter. So this is usually some big, huge number. Okay, issued means that's what the company has actually issued to shareholders. I mean, this is what they've sold. Okay, so they've issued to shareholders. They've, in effect, sold this stock. They've issued it to shareholders. So that's number of shares issued. And then the third number is outstanding. These are how many shares of stock are actually out in shareholders' hands. And you would think that issued and outstanding would be the same. And the reason they're not is because the company can buy its own stock back. So issued is how many they originally sold. Outstanding is how many are actually out in other people's hands. Once a company buys its own stock back, it's no longer issued. It's no longer outstanding. Okay? We don't count it as stock if we bought it back, because we can't own ourselves. Are we what?
Would we be counted in the issued section? What if like outstanding? If we buy our stock?
Yeah. The stock, once we've issued it, it stays in issued. Outstanding is after we buy it back, it stays in issued, but it's not in outstanding anymore. Yeah. Okay. So again, outstanding shares are the number of shares of stock that are in the hands of the shareholders. And now what we're going to do is we're going to do a homework problem. We're going to do short exercise 10.5. And 10.5 is a really quick little exercise. 10.5, basically, we go over journal entries for when we're issuing stock. We do it two different ways and compare. So quick little exercise, 10.5, we have case A. We issue stock in one transaction, and we buy equipment with the money in another transaction. So that's case A. Case B, we issue the stock for the equipment all in one transaction. So all we're doing is contrasting these two things. So the first thing we're going to do, case A, we issue stock first, and then we buy our equipment. So when we issue stock, case A, we issued 17,000 shares of its $25 par value common stock for cash of $756,000. So that's what we're doing here. We have cash, $756,000 we're told. Then we're going to credit common stock. Common stock is always credited for par value, 17,000 shares times $25. So we have the $425,000. So then our paid-in capital and excess of par is the difference between our cash and the par value. That's it. Okay? So this journal entry, very similar to the journal entries when we started. This is simply issuing stock for a price above par. That's where we started. This is common stock. We issued it for a price above par. Now, the second transaction, still in case A, is in a separate transaction. Odell used the cash to purchase a building for $548,000 and equipment for $208,000. So what we're going to do here is we're going to debit the building for the $548,000, debit equipment for $208,000, and then the combined there, the combination is cash totaling $756,000. And that's for purchasing these assets. So case A, we had one transaction where we issued the stock, the second transaction where we take the cash that we got and buy the equipment in the building. So now case B, we issue the stock to purchase the assets. So now we're doing it all as one thing. So what's going to happen when we do it is we're going to debit the building and equipment just like we did before. Common stock is credited for par, and then paid-in capital is the difference between our debits and our credit. The paid-in capital line is almost always the plug figure. So you take your debits minus your credits, and you get what that paid-in capital figure should be. And then the last question in this problem says, are the account balances similar or different after looking at this? Both case A and case B end up with exactly the same situation. So the answer for are the account balances similar or different? They're similar. They're the same. After you post both transactions, they will be exactly the same. It's just one we did it in one step, the other one we did it in two. So it makes no difference. Okay, so now brings us to the end of issuing common stock. Now we get into the next big category of things, and this deals with treasury stock. You know how I said we could buy our own stock back? There's actually a name for that. It's called treasury stock. So that's where we're going now. Okay, so treasury stock. Treasury stock are shares of the company's own stock it has bought back. And there's lots of reasons that companies will buy their own stock back. They might want to, they think their stock is undervalued, so they'll buy it low and plan on reissuing it later for a higher price. They want to avoid a takeover. They want to increase earnings per share. There's all these reasons. IBM Corporation, lots of companies do stock buybacks. I mean, it's pretty much every company does it for various reasons. IBM's board of directors just authorized a stock buyback of $5 billion. This is in addition to the $13 billion they used last year. So they're out buying their stock. And why are they doing it? IBM has money and they feel their stock is undervalued. They also want to increase their earnings per share. So how does buying your own stock back increase your earnings per share? With earnings per share, in a nutshell, what you're doing is you're taking your net income, dividing by all your outstanding stock. So your earnings per share figure is really important. And just a penny makes a huge difference because you're talking millions and millions of shares. So investors watch for earnings per share. So, and again, it's your net income divided by your outstanding shares. So if you go to market and buy back a whole bunch of your own stock, your outstanding shares figure decreases. And if it decreases, then earnings per share goes up. Now investors can see this, but it still apparently gives investors warm fuzzy feelings because IBM is doing great. This is pretty much what they've been doing, is buying back their own stock. Other companies will buy back. Starbucks has an employee incentive program, and they want to have their own stock to give out as part of this program, so they will buy their own stock to have it on hand. Companies that use their own stock in pension plans or 401k plans will buy their own stock. So there's all kinds of reasons companies buy their own stock back. McDonald's is right now is buying a lot of its own stock back. It's very, very common. So, but it's called treasury stock when we buy our own stock back. Okay, now treasury stock, easy to record purchasing it. When we buy treasury stock, it all goes into treasury stock. We don't have to worry about par value. We don't have to worry about original cost or anything. So for example, if we buy $4 billion of treasury stock, we're going to debit treasury stock, credit cash. That's it. Treasury stock, when we buy it, we debit treasury stock. Now treasury stock, this is important, treasury stock is known as a contra stockholders equity account. That means that it reduces stockholders' equity. You cannot own part of yourself. When you're buying your own stock back, you are reducing the amount of stockholders' equity. Again, just a reminder, the PowerPoint slides are available on Blackboard, and I see them in front of me in various places. So if you don't quite get anything, know that the slides are there for you for later if you want them. Actually, optimally, you would have them before or have them on your tablet. Okay, so contra stockholders equity account, what treasury stock is. Okay, treasury, again, you're not going to have time to write this down. The point I want to make on this slide is in the stockholders equity section, treasury stock is a negative. It's a contra stockholders equity account, so it reduces stockholders equity. So you will see it as a negative. Treasury stock is a negative. Negative number, not a negative for the company necessarily. Okay, so we can go buy treasury stock. When we buy treasury stock, we record it at the cost. Then down the road, we may reissue it. We might sell it. So we go and we sell it. When we sell treasury stock, it increases assets and equity. It increases assets because we get cash for it. It increases equity because we're getting common stock again. However, we never, ever, ever have gains or losses involving our own stock. We have paid-in capital increases and decreases, which we'll see. We're going to do a homework problem where you see what happens when we sell it. So you'll see that coming up. But the rule, this is a very big deal. We cannot have gains and losses on our own stock. We cannot have gains and losses on treasury stock. So what we're going to do now, we're going to do a few questions and we're going to head into a homework problem. Okay. So treasury stock increases assets and equity, no gains or losses on transactions involving treasury stock. Okay, so now we're going to do a couple questions again. So the next question up, it's out there now. The purchase of treasury stock by a corporation increases total assets and stockholders' equity. True or false? Okay, true or false? The purchase of treasury stock by a corporation increases total assets and stockholders' equity. We're going to leave this open for about 10 seconds, and then we're going to close it. So get your answer in now. Any answer? Participation. So if you're not sure, yes. Okay, the answer is false. When we purchase treasury stock, it decreases total assets. It's reducing our cash. We have to purchase it with cash, so it'll decrease cash. It'll also decrease stockholders' equity because this is a contra account. Treasury stock reduces stockholders' equity. So when we purchase treasury stock, cash goes down, stockholders' equity goes down. So it's actually the opposite of what this question said, and that's why it's false. Okay, one more question. Treasury stock is a contra stockholders' equity account, true or false? Treasury stock is a contra stockholders' equity account, true or false? We're going to close it in about 10 seconds. Just a reminder that the question numbers have no meaning. They are just question numbers for Kaylee and I to get the right one. Okay, that one's true. Treasury stock is a contra stockholders' equity account. Okay, now we're going to do short exercise 10-8. Short exercise 10-8. A corporation reported the following stockholders' equity. So it's giving us the stockholders' equity section of the balance sheet. And then during the next year, they purchased treasury stock at a cost of $34 million and resold treasury stock, some of it, for $15 million, and they tell us the parts of the chunks that they sold had a cost of $6 million. So we're told to record the purchase and sale of the treasury stock. So just a couple words here about what we're given in terms of the stockholders' equity section. Common stock typically is the first account given, and then additional paid-in capital, that's what investors, for example, investors have been paid more than the par value, and that's what's in there. And then we have retained earnings, which is this running total of earnings to date less any dividends declared. And then treasury stock. And see that treasury stock shows as a negative because because it's a contra stockholders equity account and it reduces stockholders equity overall. Okay, so during the next year, purchase treasury stock at a cost of $34 million. So we're going to do that first. So we're first of all going to record the purchase of treasury stock. I love to see purchases of treasury stock because they're the easiest journal entries I can do. When I purchase treasury stock, I'm going to debit treasury stock, credit cash for the cost. So this one's super easy. We have treasury stock debited for $34, cash credited for $34. So you want to make a note that when we purchase treasury stock, it's recorded at cost. These are easy points. If you have a question about purchasing treasury stock, it should be really easy for you because when we purchase treasury stock, we're going to just debit it at cost. We don't have to worry about how much is par value or anything like that. Just debit treasury stock. Okay, the next part of this then says we resold the treasury stock for $15 million, and it tells us it had originally cost $6 million. So we're being told we didn't resell everything. We just resold a chunk of it, and it cost $6 million. So just walking through this before I put up the slide. First of all, the cash we received for this transaction is $15 million. So we're going to debit cash. So that's an easy side. So we're going to debit cash $15 million. And then we're going to credit treasury stock for the cost. So we will credit treasury stock for the $6 million. Okay, so we have cash debited for 15, treasury stock for 6, credit for 6, the original cost, and then paid in capital is the difference. Treasury stock is always recorded at cost. Okay, so it's always when we sell it, we have to take it off the books at cost. And then the difference, so treasury stock is always taken off the books, the cost is taken off the books. And then the difference between the $15 million cash and the cost of 6, that 9, goes into paid in capital, and we technically call it paid in capital in excess of cost for treasury stock transactions or something like that. Notice there are never any gains or losses on treasury stock transactions. We do not ever have a gain or loss in our own transactions, on our own stock. If you look at this, we spent $6 million on the treasury stock, sold it for 15. You could say, whoo, we made $9 million. We cannot call it a gain or loss though. We do not have gains and losses from our own transactions. It simply goes into paid in capital. That's because companies could do all kinds of terrible things if they were allowed to have gains and losses on their own stocks. They could do a lot of misleading things. So no gains or losses on our own stock. It goes into paid in capital. Okay, now the last question says, how much did stockholders' equity increase or decrease as a result of the 2 treasury stock transactions? Okay, so how much is stockholders' equity, and this is in total. So the 2 transactions we had, I'm going backwards in time here. The first transaction, we see treasury stock there. Treasury stock decreased stockholders' equity, right? We debited treasury stock, stockholders' equity increases with credit. Treasury stock, we bought our own stock back. That decreases stockholders' equity. So we have a decrease of 34 there. And then the next transaction that we had treasury stock credit of 6 and paid in capital credit of 9. So there's 15. So we had an increase in equity from this transaction of 15. So when we go to answer this last question, how much did stockholders' equity increase or decrease as a result of the 2 treasury stock transactions? Well, it decreased by a total of 19. How I got that? The 34, the first transaction reduced stockholders' equity by 34. The second transaction increased it by 15, so the difference is 19. So stockholders' equity, SE, stockholders' equity decreased by 19 overall. Okay, and that's it for that homework problem. Now we have another question coming out via Learning Catalytics. Again, the question numbers don't mean anything to you. Casey's Computers purchased 4,000 shares of its own $10 par value common stock for $92,000. As a result of this transaction, what happened? What I would do with this is I would look at the entry that you make for purchasing your own stock. What does that entry look like? And then try to match it up with one of these answers. So we'll give it a little bit of time here. Again, look back at your notes for the entry where when we purchased treasury stock. What does that entry look like? Okay, when we issue or when we buy treasury stock, we're buying treasury stock, that entry is going to have two lines. It's going to have a debit, and it's going to have a credit. They're both going to be for the cost. So again, we're going to close this question in about 10 seconds, so get your answer in. Okay, so treasury stock, we buy treasury stock. Okay, when we buy treasury stock, for this transaction right here, we would be debiting treasury stock for $92,000, crediting cash for $92,000. When we purchase treasury stock, it's that easy entry. It's the cost goes into treasury stock, the cost goes into cash. So in this case, paid-in capital, answer A is not it because paid-in capital is not part of that entry. We're debiting treasury stock, crediting cash. Entry B doesn't do anything. We don't deal with common stock either. So it can't be B. So now we're down to C or D. So how much is this transaction for? This transaction, we spent $92,000. So the correct answer is C. It's $90,000. We spent $92,000. That entry, when we purchase our own stock back, debit treasury stock, credit cash for the cost. Okay, let's try another one. Okay, if treasury stock is sold at a price greater than its reacquisition cost, greater than what we paid for it, what do you do with that difference? To answer this, you would look at the second journal entry for the exercise, the homework exercise we just did. In that homework exercise, the second entry, we sold stock at a price, treasury stock at a price higher than what our cost was. Okay, another 10 seconds. Final chance, another 5 seconds. Okay, and what we're going to do here is we are going to credit to paid-in capital. So when we sell treasury stock for a price more than our original cost, we are going to be debiting cash for the total amount. We're going to be crediting treasury stock for the cost. And then the difference between that goes to paid-in capital from treasury stock. Notice that C and D cannot be it because retained earnings is not part of that at all. Retained earnings doesn't get hit with treasury stock. So basically we had to pick A or B. It worked the same as in the homework problem. So again, I would have those journal entries beside you, nice reference points. Okay, so the next topic we have is stock splits and dividends and stock dividends. And given where we are time-wise, 5 minutes isn't enough, so I think we're going to end here, and then we'll pick up with that on Wednesday.